The housing market is collapsing in a way we have not seen since 2008. Zillow's home price index now stands at $358,000, a number that has remained flat for over 3 months following nearly 2 years of rapid, unsustainable growth that has priced most new buyers out of the market. But while the market crash has not yet appeared on this graph, there are clear signs that we could be entering a crash just as bad, if not worse, than 2008. If we study history and go back to 2007, we find evidence that the first signs of a crash almost always appear in certain markets throughout the United States. The common belief was that all crashes begin in the desert, and the data from 13 years ago tends to back this up. For example, in Phoenix, Arizona, according to Value-Wide Homes, the average price of a single-family house in 2007 was $336,000. 4 years later, in 2011, this number had crashed to $157,000, an insane 53% crash that took over 48 months to reach the bottom. Meanwhile, if we zoom out across the nation during the same time period, the overall housing market was slightly different. In 2007, the median home price in the country reached $257,000, peaking at essentially the same exact time as the Phoenix market. But the market only crashed for 24 months, falling around 17% before reaching the bottom. Not only did Phoenix fall harder, faster, and deeper than most other places, but it also took much longer to recover back to peak bubble pricing. In almost every other market, had you bought in Q1 of 2007, you would have seen a recovery in price by 2013, about 6 years after the collapse. In Phoenix, however, the same person buying in Q1 of 2007 would have had to wait until 2019 before they saw their house appreciate back up to the same prices we saw in 2007. That's over a decade of waiting. These attractive markets like Miami, Las Vegas, and Phoenix are always the first and hardest hit during bear markets, and studying them can give us a clue into future crashes. The first clear sign of this demise in the market can be seen with demand data. In Phoenix, during April of this year, a typical house would sit on the market for just over 20 days before selling. Historically, this is extremely low and goes to show just how competitive the market was. Today, this number has shot up over 100% in less than 8 months and continues to rise as we approach the end of this year. Now homes are taking months to sell, and sellers are finally capitulating, with over 50% of listed homes forced to reduce prices. Earlier this year, this number was down to 12%, which represents a 400% increase in less than 1 year. Of course, one can read all of this and say, well, you're ignoring the most important data point there is, price. And while yes, median prices have remained high, they are finally seeing signs of a slowdown, dropping from the summer high of $470,000 to the current price of $430,000. But if we continue to see the demand data trend in the wrong direction, this false hope sellers are holding on to will quickly shatter. Analysts, experts, and even investors, in my opinion, are still not aware of just how much damage has been done to the housing market in the last 6 months alone. While graphs like these show some of the signs, it's not a true representation of what's happening out there, because housing isn't just a matter of price. The majority of homes in this country are bought with a mortgage, which means interest rates play a big role in determining affordability. For example, while the Phoenix market just recently reached its peak in May of this year, it can be argued that currently homes are more expensive than what they were just a few months ago, despite this clear dip in the graph. This is because in May, the average 30-year rate was 5%, meaning that the true cost to own this $470,000 home in Phoenix was around $2,900 a month. Today, the same house, according to RedFin, is cheaper, with median prices hovering around $430,000. But the 30-year rate has jumped up to 7.25%, which signifies that despite the home being $40,000 cheaper, your monthly payment is actually $3,200 a month, or nearly $300 more. Interest rates have a massive tsunami-like effect on the entire market, and with more pain ahead, there's a significant shock occurring in the markets. Post-pandemic prices were already outrageous even as rates were low. Now, not only are they inflated, but we're approaching double-digit rates and a complete collapse in demand. Combined, these factors are set to completely destroy the markets in a way that makes this crash even worse than 2008. At the start of the year, many were ignoring the initial signs, but now even CEOs of major home builders are admitting that things are not looking good for 2023. Take a listen to Doug Bauer, CEO of TriPoint Homes, explain where he thinks markets are going a year from now.
That kind of is really the tale in the setup for 2 different years, 22 and 23. You know, as Diana reported on the resale market, we reported demand very sluggish. The interesting thing, and the consumers on the sidelines. On one hand, they see and hear the headlines about rates going up. On the other hand, where are prices going to go? And we reported orders down 50% year over year. Generally, the whole industry is selling at half of what it should be selling. So, I would, David, I would say housing is the canary in the coal mine.
Canary in the coal mine for what?
Well, the Fed, if the Fed is listening, I know they know this, but housing, which has its multiplier effects, is the tip of the spear of the economy. And these rapid rate increases that has caused, I think you asked me at a previous show, is housing in a recession? Housing is in a significant dislocation, which is going to lead the economy to a pretty strong recession. So this is all leading up to a very tough 2023 as you look at housing. But
So as you just heard there, home builders are now admitting that things are not looking good going forward. While Doug admits that the carnage is partially due to interest rate hikes, he also references the idea that a large majority of these issues in demand are psychological, claiming that it's the rapid rise in interest rates that has forced many buyers to sit on the sidelines. Unable to cope with the fact that rates, which have hovered under 5% for years now, are suddenly jumping up to unthinkable territory. He claims that once rates normalize, or once people understand that this is the new normal, they will be returning to the market.
I will point out, David, it's not that bad if you really take a step back and if the Fed would settle down and these rapid rate increases would settle down and there'd be some stability in the mortgage market, there is tremendous pent-up demand, and then prices will reach payments at whatever mortgage it is, whether it's 7%, 7.5%.
All right, yeah, that was my follow-on question then. So if we do sort of get to a place and just have normalized rates, the rates at least you and I may have grown up with, you think you can have a pretty strong housing market?
For sure. I mean, because we're seeing the needs-based buyer, the reload buyers, it's really the needs-based buyers. But I can't tell you the amount of significant pent-up demand. I mean, you look at this industry, we just barely tapped into the millennials and frankly, the active adult. A company like us, we're well positioned with our land that we bought pre-22. We have strong margins to withstand prices, but it's just math. All you have to do is know that the mortgage rates are at 7 or 7.5, and then we'll adjust pricing to the payment, and the consumer will re-engage. I can tell you right now that the consumer is more psychologically challenged than payment challenged. The income levels for the millennials, which represents 57% of our buyers, is very strong.
We shouldn't be surprised at this optimism coming from a home builder CEO, but the data says otherwise. Black Knight indicates that home prices, while down only 2.6% since June, are trending at a pace not seen since the Great Recession. In fact, this is the worst 3-month decline since early 2009, and as the rest of the economy slows down with real estate, the carnage may be much worse than what Doug leads on. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.